Thank you
We
very
have
much.
one of your Arkansans here.
I know that. Very, very proud and excited. I apologize for being a little late. I was presiding over the Senate, which I think is the Senate's version of paying your dues, right? Thank you all very much for your time. I want to touch on the mortgage servicing business, a specific concern I have about the mortgage servicing business being driven into a largely unregulated shadow non-bank system. Some reports I've seen suggest that you've seen at least a doubling, if not a tripling, of non-bank companies moving into the mortgage servicing business. A lot of banks are divesting of this business. And I wanted to ask first why you think this is, and maybe we could start with Ms. Eberly.
So not a lot of the banks that we supervise have significant amounts of mortgage servicing businesses. By and large, community banks, it's very small amounts that are doing it, and they're keeping it.
Okay. Ms. Hunter?
Yeah, the mortgage servicing industry certainly has undergone significant changes in recent years. So we are noting that there is some shift away from the larger banking organizations. But at this point, I don't know that I could add any more insight into that.
Senator Cotton, I would share what was been said also, but I also would say there's that continuing innovation and speed of delivery and technology is making a big difference in who can provide the services at a more effective cost, and that's been a big driver as well.
Most credit unions portfolio their mortgages and they service them. Not many credit unions hold mortgage servicing assets on their books. A few do. It's a very small percentage, and we haven't seen any real trends to move those outside of the credit union portfolio.
We feel the capital requirements that are causing these mortgage servicing rights to be taken to other sources will cause relationship lending to be dampened, and we would like to see our banks be able to continue to service those mortgages that they produce. You know, state regulators, many state regulators, I don't, but many state regulators do regulate those mortgage services companies, and I know that they are looking at prudential standards for those companies.
And, Ms. Hunter, you're talking about the regulations implementing the Basel III capital requirements?
Right.
I have to say that I tend to agree with your assessment, Ms. Hunter, and that's not just chauvinism for Arkansas, but this is, what I've heard and what I've seen in other studies. So, one question, that I'd like to ask is, was there any study in particular on the assets that the regulations implementing the capital requirements would have on the mortgage servicing business? Not the general study on capital requirements, but specifically the impact it could have on the mortgage servicing business, especially of small and mid-sized banks.
So we absolutely looked at it for community institutions in response to the comments we received as part of the capital rulemaking. And as I noted, there are very few community institutions that are engaged in mortgage servicing to a level that would have been impacted by the new capital rules.
Ms. Hunter?
Yeah, I would only add the goal of the capital rules was to make the capital regime more resilient. And as I understand it, in going through the comment process, looked at various classes of assets, those that were proved to be less liquid in the financial crisis, and when needed more liquidity in those assets, those tended not to get the more relaxed treatment that some of the other assets perhaps received in the final rule.
Well, I appreciate the goal. I just feel that this may be another instance in DoddFrank and its implementation and the overall regulatory environment we've seen over the last few years, where we've actually been aiming at one goal and maybe having the opposite result, driving activity out of the regulated banking and credit union sphere and into non-bank businesses. And this, to me, it seems like this is a problem for at least two reasons. One, for community banks in particular, especially in a state like Arkansas, and I know states like Alabama and Tennessee and other states represented here, that is a good business, provides a good margin, is relatively safe assets. But two, it's also very bad for the people we serve, the consumers of those banks. Rather than dealing with a small bank in a place like Yall County, Arkansas, or for that matter in Pulaski County, Arkansas, which is small by Washington standards, they may end up now dealing with esoteric and obscure non-bank entities that are far away. where they have less recourse and less protections than they would if they were dealing with their community banks and their credit unions. My time has expired. I want to thank you all for your time, and Ms. Hunter, thank you in particular for increasing the number of our candidates we have in Washington today.
Senator Corker.
Well, thank you, Mr. Chairman. I apologize for
Ms. Franks, sorry.